welcome to the deep dive. We know your feed is probably drowning in corporate news right now.
It definitely is.
Which is why we've processed this huge stack of sources covering just the last 24 hours, October 27th to 28th, 2025, and we've boiled it down to, well, the few really crucial high-impact moves you should be tracking.
Yeah, we are deep in Q3 2025 earnings season. And honestly, the volume of just routine updates is overwhelming.
Right.
Those companies are just sort of checking the boxes. So our mission today is really to cut through that static. We want to focus purely on the strategic shifts, the M&A, the big partnerships, those SEC filings that signal real conviction or maybe lack of it.
Exactly. We're looking for action, not just companies waiting for their earnings call. So today's deep dive is zeroing in on three sectors that really made the most noise with proactive decisions: fintech, pharma, and athletic apparel. Okay, let's get into it. All right, let's start with the immediate stuff companies reporting today, October 28th. And fintech is generating some serious buzz, starting with SoFi.
SoFi is reporting pre-market. And the expectation is pretty high, looking for significant expansion. Forecasts suggest their EPS will land around 0.09 cents. That's a projected 80% growth from the 5 cents they reported a year ago.
And something interesting happened just last week leading up to this. The consensus EPS forecast, it actually got bumped up from 0.08 cents to 0.09 cents.
Oh, okay.
That subtle revision kind of suggests analysts are feeling more confident about their lending performance, maybe their efficiency going into this morning's numbers.
Right, that's a positive sign. Then you've got PayPal, probably reporting after the market closes. With PYPL, the crucial thing isn't just profit, it's really about volume and stability. Transaction revenues are expected to grow.
To what level?
To about $7.45 billion, up from $7.07 billion year over year. So decent growth there.
But isn't the real story of PayPal the leadership change? This is the first earnings report under the new CEO, right?
Absolutely. That's the key focus.
So what are you looking for beyond just those raw revenue numbers? Do they need to deliver a specific message, you think?
Oh, definitely. I mean, the numbers are almost secondary to the forward-looking strategy this time around. They need to provide firm, actionable guidance on improving margins. They have to articulate a clear, long-term plan. The new CEO really has to show they've got a distinct vision for, restoring growth and setting themselves apart in a very crowded digital wallet space.
Yeah, makes sense. And speaking of delivering, we should quickly mention Lending Club. They already had a big win last week.
That's right. LC's earnings beat was significant. Their EPS came in at $0.37, which was, quite a bit above the $0.30 expectation.
And what drove that?
Pure momentum, really. Robust loan growth climbed 37% year over year. That's a powerful tailwind, especially in the current rate environment.
Okay, so while those reports gave us the look back, let's pivot now. Let's talk about the companies actively writing their next chapter now.
Okay, this is where we see some real strategic confidence playing out. And based on everything we looked at, Eli Lilly, they made the single biggest, most proactive statement across the entire 24-hour cycle. It was like a triple play of growth signals.
A triple play. Okay. Let's unpack that LOI activity. First, they went big on M&A. Agreed to acquire Adverum Biotechnologies for up to $12.47 per share.
Right. That's a clear move to bolster their specialty pipeline. Pretty significant deal size.
Second, and this is the part that really stood out to me, they announced plans to invest $5 billion to expand drug production capacity.
Yeah, staggering, isn't it? That is not routine capital expenditure. A $5 billion investment signals massive multi-year confidence. Confidence in demand, confidence in their ability to execute on their current portfolio.
Yeah.
Especially those blockbuster weight loss and diabetes drugs.
Huge bet. And third,
they also released positive new clinical data. This was for their ulcerative colitis treatment, Omvo. It showed improvement in bowel urgency symptoms for patients.
So clinical success, massive investment, and an acquisition, all hitting basically at once. That's how you dominate the narrative.
Definitely. Now, moving over to athletic apparel, we saw kind of a power move from On Holding, that's ONON. They announced a major long-term partnership with a world-class tennis star.
Okay, but why does this partnership matter more than, say, a standard celebrity sponsorship? Is it just marketing spend or something else?
No, not at all. And this is where the details really count, The partnership explicitly includes co-developing and launching a new performance tennis shoe line tied to the athlete's name.
Co-development.
Exactly. This isn't just an athlete wearing their shoes, it's an integrated premium push. Really signals Onon's ambition to compete way beyond their core running shoe base into that high-end performance sports market.
Got it. Meanwhile, Comcast, CMCSA, they're targeting a completely different growth area, it seems.
Correct. They announced a major expansion of their Now WTV Latino service.
What does that involve?
Well, they're clearly looking for those high-growth subscriber pockets. The expansion brings in Univision, adds ViX Premium's ad-supported tier, plus over 100 streaming channels. They are directly targeting and investing pretty heavily in the Spanish-language content market, which is, rapidly expanding and represents a key area for potential future subscriber growth.
Okay, let's zoom in now on some competitive dynamics, where companies are really battling it out or maybe showing wildly different paths, starting with that footwear showdown.
Right, the incumbents versus the challengers. Nike held its 2025 Investor Day, and the core message really felt like defensive growth, didn't it?
Yeah, definitely. They emphasized growing their direct-to-consumer channel, highlighted new tech like Air Max Dynamic, and focused investment on women's and running.
Which are the exact segments where they're feeling the pressure.
Because Nike management knows exactly who's pushing them.
Right.
They specifically called out the strong growth from new competitors, meaning On and Hoka.
And Hoka is owned by Deckers, DIC.
Right.
And if you connect those dots, while Nike is sort of planning its defense, Deckers is riding this offensive wave. DIC got analyst upgrades from both BofA and Stifel just recently.
And why was that?
Two main reasons. First, the, quote, explosive growth of the Hoka brand. And second, strong demand for their UGG brand, especially heading into the critical winter season. It's a classic story, really. Yeah. An agile challenger capitalizing on market shifts.
Yeah, interesting contrast. The other, maybe even starker contrast we saw was in the iBuying sector, comparing Opendoor, Open, and Zillow, Z.
Yeah.
The stock performance divergence is, well, it's almost unbelievable. Zillow's stock down by 5.8% over the last 3 months.
Wow, Opendoor.
Opendoor surged over 240% in the same period.
It's pretty incredible. And this is a classic case, I think, of the market betting on a business model over current financials. Because if you look at Opendoor's last reported results, Q2, they showed an 8.1% gross margin and a $29 million net loss.
Right. So why the 240% surge then? What's the bet?
The market is betting heavily, it seems, on Opendoor's operational efficiency, their data science. The belief is they have the better, more scalable proprietary model for actually buying and selling homes quickly.
So investors are willing to look past the current losses at Open because they believe the underlying unit economics, once they achieve scale, will beat Zillow's more hybrid approach, which is less focused just on iBuying and more on other services like rentals and mortgages.
That's the conviction play, yeah. It's a bet on the core iBuying tech and process.
Okay, shifting focus now to the next, say, 48 hours or so. We've got several situations where high anticipation, or maybe some unusual activity, signals potential volatility ahead for you. Let's start with high hype earnings.
Yeah, Carvana, CVNA, they report on October 29th. And the expectation is just through the roof. We saw one major analyst, Jim Cramer, actually say CVNA is set to blow the doors off their results.
Wow, that sets a high bar.
It really does. And when expectations get that high, even a slight miss or maybe just meeting expectations can trigger massive volatility. So one to watch closely. Also, Bausch Health, BHC, reports post-market on the 29th. Analysts are similarly expecting an earnings beat there too.
But besides earnings hype, we also saw some significant business risks popping up. Starbucks, for instance.
Facing potential labor issues. Baristas are apparently planning a no contract, no coffee strike, and they seem to be strategically targeting the company's ultra-popular Red Cup Day.
Oof. That's a direct hit on a key high-volume marketing event. That could hurt.
It definitely could. Meanwhile, Dutch Bros, BROS, is facing some scrutiny for what analysts called a bold new betting.
Which is?
Their recent move into selling egg-based breakfast menus. Analysts flag this diversification into food as a significant operational risk, execution risk mainly, and warned it could potentially lead to a rating downgrade if the rollout stumbles.
Interesting. Okay, finally, let's talk insider movement. This often gives us a glimpse into executive confidence, right?
It can, yeah. Look at Coinbase. Coin stock has rallied recently, up about 10% thanks to Bitcoin's surge.
Right.
But at the same time, news surfaced of executive stock sales.
Who is selling?
This is where understanding the filings matters. We saw sales by the CEO, the chief legal officer, and the CFO based on recent Form 4 filings.
And a Form 4 means?
Form 4 means the trade already happened. It's an actual sale of stock that's been completed.
Got it.
Now, contrast that with Block, SQ. They filed multiple Form 144s and also some Schedule 13GA filings.
So what does a Form 144 tell us differently?
A Form 144 is just an intent to sell restricted stock. It's basically a planning document. Signals an executive is preparing to sell, maybe when they're legally allowed to, but it's not an immediate transaction necessarily.
Oh, okay. Planning versus action.
Exactly. Wayfair W also saw an executive file a Form 144, signaling intent to sell about 85,000 shares valued around $7 million. So it's really important to distinguish between executives actually selling into a rally, which is the Form 4, versus just preparing for future liquidity, the Form 144. Both are signals, but one is much more immediate.
That's a really useful distinction. Okay, so wrapping this up, what does this all mean for you as you process today's news avalanche?
Well, we've seen Eli Lilly really dominate the proactive growth story, haven't they? Massive M&A, huge investment. The heart of earnings season is peaking right now with SoFi and PayPal today. And those competitive dynamics, whether it's Nike defending turf or that huge divergence in iBuying, they're really defining several sectors.
Yeah, our sources definitely paint a picture of a market full of volatility, risk-taking, lots happening.
Exactly. And that brings us to maybe the most important signal to watch right now. That contrast between insider versus institutional conviction.
Okay.
You really need to focus on the difference between executive stock selling at companies like Coinbase and Block, where leadership is maybe cashing out a bit after a rally, versus the stock purchases we saw from big institutions, like Sterling Investment Management buying PEP or Oppenheimer Asset Management buying CSGP.
Why is that contrast so critical right now?
Well, think about it. When executives consistently sell into rallies, it can signal a lack of long-term conviction, maybe at the very top. Conversely, when big institutional managers are buying shares in established, maybe more defensive names like PepsiCo or specialized tech like CoStar Group, it suggests that while, yeah, high-growth sectors have hype, the quote-unquote smart money is still looking for stability, looking for long-term calculated growth in businesses they think are undervalued or perhaps more resilient. That difference between an executive taking some profits off the table and an institution placing a long-term strategic bet, that's often the best indicator of future health, you know?
That's a really fascinating dichotomy to keep an eye on. We definitely invite you to explore those filings yourself and decide which signal resonates more with you, the executive selling into the rally, or the institutions buying for the long haul. That's it for this deep dive.